At JPMorgan, one metric we constantly analyze to understand companies' core profitability was EBITDA. But why is it so important and what does it really reveal about a business? Hi, I am Dheeraj Vaid, the co-founder of Wall Street Mojo, and today I'll break down EBITDA, what it means, why it matters, and how it drives key decisions. Let's jump in. So, what is EBITDA? EBITDA is nothing but earnings before interest, taxes, depreciation, and amortization. So, EBITDA is usually used to understand how the core business of the company is performing as such. So, let's say think of oil and gas companies that are into exploration, for example. Now, the core job is essentially to extract oil from oceans and other oil reserves and sell it in the open market, right? So, how much amount of revenue and cash that they are essentially earning by these core operations is or can be represented by this term called as EBITDA. Now, just to give you an intuitive sense of what I am trying to say, let's imagine that this is the company, the same oil and gas company which we were talking about. Okay. Now, they have generated sales of 10,000, and on the bottom, you can see the bottom line, that is the net income, that is $900. Okay. Now, if you just look at the net income, what does this signify? This signifies the income that the company has generated after taking care of all the expenses that has happened within the company. So it could be related to the core business operations, it could be the interest payments which the company might have done, the tax payments, and the depreciation and amortization for the assets which they have bought over a period of time. So it is taking care of all the items in terms of expenses. But what about the business performance from the core business point of view? So this is where EBITDA comes into picture. Now you must be wondering, where do I find EBITDA? Because when you look at this income statement, you do not have EBITDA numbers given by the company. If you look at the 10K reports or the annual reports, very few companies will disclose EBITDA numbers. So it will be your responsibility as an analyst to find EBITDA. Okay. Now, when it comes to EBITDA calculations, there are two approaches to finding it. So the first one is called as the bottom up approach. Okay. And the second one is the top down approach. So both of them are different, of course, but the answers will be same because we are talking about a tangible number, that is EBITDA. Okay, so let's discuss this first one first. Bottom up approach. Now, bottom up approach is nothing but using this formula of EBITDA. Now, what does this thing says? Earnings before interest, taxes, depreciation, and amortization. Okay. Now, think of this income statement altogether. What is essentially called as the earning? The earnings is nothing but the net income, right? So we will start with the net income. We'll say, okay, let's start with the net income. That's the bottom of the income statement. And we have to find the earnings that is before interest, taxes, depreciation, and amortization. So what we do is we keep on adding back those items. So we will add interest, we'll add taxes, we'll add depreciation, and then we also add amortization. So what do we get essentially is EBITDA. Okay. So this is how we calculate EBITDA using a bottom up approach. So just to reiterate, we start with the net income, that is the earnings, and then we keep on adding back these items. Okay. So let's calculate and find out the EBITDA for this company A. So this will be net income, that is 900, plus interest. Interest is 1000, taxes 500, depreciation is 500, amortization is 100. Okay. So what do we get? We get EBITDA as 3000. Okay. So this is the core earnings from the business. All right. Now, one more important thing about bottom up approach is that this formula, which we have written about EBITDA, net income plus interest plus taxes plus depreciation and amortization, the first three terms, when we add them together, they're also called as EBIT, that is earnings before interest and taxes. So the formula essentially becomes EBIT plus depreciation plus your amortization. Okay. So from this income statement, if you look at what is the earnings before interest, taxes, that would be, let's say, net income. When we get and add back taxes and add back interest, we approach this operating profit. This operating profit is sometimes called as EBIT. So this formula of EBITDA would be nothing but EBIT plus your depreciation and amortization. So a bottom up approach. Okay. Now let's now look at the top down approach to calculating EBITDA. Now, for doing a top down approach, it is fairly simple. You start with the top, right? Top is sales, right? And now you start deducting those items which are core to the business. Now, which are the items which are core to the business in the income statement when we look at? Now, this would be cost of goods sold, because this includes all the costs which are directly associated with the sales. And we also have the SG&A expense, that is selling, general, and admin expense. So, let's do the calculations. This will be sales minus your COGS, cost of goods sold, minus your SG&A expense. So EBITDA here will be like this. This will be 10,000 minus 5,000 minus SG&A expense, that is 2,000. So what do we get? We get EBITDA as 3,000, which is one in the same, right? So whichever formula you use, you will get the same answer. Now, with that understanding of EBITDA, let's revisit the same question we asked you in the introduction. Company A versus Company B. Both the companies had the same sales figures and the same net income figures, right? But how do you find out which company is better from the core business point of view? We've discussed this enough until now, because we know that EBITDA is the measure. Okay. Now, just imagine if company A is in United States and company B is maybe in Russia. Now, taxes might be different, right? So, in order to compare that, you have to have a measure which is above this, right? Likewise, company A versus company B, maybe both might have taken different levels of debt. So, interest expenses could also be different, right? So, in order to compare and make it peer to peer, we have to go back to a measure which is before this interest as well. Likewise, when you look at this depreciation and amortization, company B has a higher depreciation number. That means, they might have invested more heavily in the assets, right? So, how do I compare that? So, that's why we have to find a measure which is before depreciation as well. So, we are talking about before taxes, before interest, before amortization and depreciation. So, we essentially arrive at EBITDA, right? So, let's find out EBITDA now. So I'll be using the same bottom-up approach because that is fairly simple. We can calculate EBITDA fairly quickly using that. So EBITDA is equal to net income plus taxes plus interest plus amortization plus depreciation, right? So this comes out to be 3,000. We've done this earlier. And what about company B? I'll just copy and paste the formula. And we see that this comes out to be 3,500. So as the sales numbers are same and net income numbers are same, but EBITDA is different, we can conclude that company B is performing much, much better in terms of their main or core business point of view. And that's how you make use of EBITDA. So EBITDA can be used not only to compare this company A versus company B, but EBITDA is used by analysts for many different reasons as well. One of the primary reasons is that EBITDA can be a good proxy to cash flow from operations. Now, why do I say so? Is that think of how cash flow from operations is made. It starts on net income and then it starts adding back all the non-cash expenses. Now, EBITDA is also similar, right? Because it doesn't consider depreciation and amortization, it adds back, right? So it's an item before this depreciation and amortization. So EBITDA can be used as a proxy to this cash flow from operations. Number two, EBITDA is widely used for valuations. Now, this is the most important, uses of EBITDA. Essentially, when we talk about mergers and acquisitions, And there is this thing called as the comparison and the transaction comps. So in the transaction comps, when we talk about, we compare how company C or company D has been valued on the basis of EBITDA, how many times EBITDA was their valuations. So think of, let's say, company C, which got recently sold off. And the valuation for company C was, let's say, 6 times of EBITDA. Okay. So what this means is that company C, which operates in the same sector as company A and company B, was sold at 6 times of its EBITDA. So let's say if you're doing a valuation of company A, then you have a good measure to find out the valuation of company A, right? Because you can see what company C was valued at, and then you can simply multiply 6 with the EBITDA of company A to find the valuation of company A, right? So this is another use which analysts make for from EBITDA. EBITDA can be very helpful in evaluating unprofitable businesses as well. Now think of this company A, for example. It is profitable because it is generating positive net income, right? But let's say if its cost of goods sold was 7,000, now, the net income will be minus 1100, right? And this is not a unique situation. Think of startups and those um, uh, big funded companies these days who are mostly unprofitable. So, how do you value those? So, they would be valued either on the basis of sales or on EBITDA. There are certain limitations of EBITDA as well. And let's look at the most important ones. The very first is EBITDA is not recognized by GAAP or IFRS. Now, what does this mean is that EBITDA can be subject to interpretations as well as manipulation by the management. So, even though they are not required to put EBITDA as a number within the income statement or the profit and loss statement, but if they disclose it somewhere else, it has to be taken with a pinch of salt because it is a non-GAAP measure. Okay. Number two, is that it doesn't consider how the company is growing, right? So whether the company has taken high levels of debt, no idea. Whether the company is repaying their debt, you don't get to know that number from EBITDA. So how are they doing it? We don't come to know just with EBITDA. So that's why we have to look at the complete picture as well. And like as I said, whether the levels of debt are being taken care of, or whether the company is paying off taxes or not, that's also not available when we just consider EBITDA. So these are certain limitations of EBITDA which you should be aware of.